Hello, everyone. Welcome back. This is government's role in insurance markets, social insurance chapter. We're going to talk about in this part social versus self-insurance and how consumption smoothing works in either cases. Let's get started. So, self-insurance. What is self-insurance? Basically, this is private means of consumption smoothing. Let's say there is no unemployment insurance. May God prevent I became uninsured, and me calling my parents, "Hey, mom, dad, I need money because I'm unemployed." Or, "Oh, okay, I'm unemployed. No big deal because I saved 6 months of my emergency funds. It's in the bank. I can still survive for 6 months, and meanwhile, I can probably find a new job." So this is an example of self-insurance. So for instance, in the case of unemployment insurance, income to workers, this is basically an income to workers who have lost their jobs, right? You are doing other things just like the ones I described. If there are no unemployment insurance exists in the market, you can smooth consumption by drawing into your savings, right? Emergency funds. You can borrow either in a collateralized forms or uncollateralized. So this is basically like asking your parents, "Hey, can I please borrow $5,000? Or I was watching this TV series. It's called Beef. It's a new TV series. And one friend was telling the other one like, "Sure, you can pay me later, but let me get the title to your truck." So that's a collateralized forms of loans, okay? Or have other family members increase their earnings. So I could ask my little puppy who is behind me, actually. I don't know if you can see him. He's behind me, just sitting very patiently. So I can ask Tiki, why don't you do some social media, puppy Instagram, and make some money? That's a joke. Or receive transfers from extended family, friends, organization, and just ask my parents, not for a loan, but literally give me money. I'm not going to pay you back. So have other family members increase their earnings. Obviously, I was joking about my dog because it's basically, let's say I lost my job. I was the main breadwinner. I'm asking my partner to actually start working, right? So public intervention can crowd out private provision. This happens with sometimes, to some extent, I believe, with retirement, social security benefits, because people know, "Oh, okay, I'm going to get a couple of $1,000s from Social Security Administration. I don't need to save because they're automatically taking it out of my paycheck. I should be okay." No, you should actually privately smooth your consumption through 401ks, 403b, all those accounts, right? So public intervention can crowd out private provision. As we said, there may be no consumption smoothing gain or justification for government intervention in this case if there is a crowd out. So it is really important to also think about the efficiency costs of raising government revenue, right? You are intervening in the insurance markets. You need to generate your revenue somehow, and that usually comes from taxing people. Let's talk about unemployment insurance replacement rate. This is the ratio of unemployment benefits to the pre-employment earnings. If you replace people's unemployment insurance replacement 100%, then why should they even look for a job, okay? So keeping it between 40, in my opinion, 40 to 60% is actually pretty good. So if I lose my job, I can apply for unemployment. If they pay me 40 to 60% of my pre-unemployment income, it's a pretty good deal. So you still need to do some individual consumption smoothing. So again, unemployment insurance replacement rate is the ratio of unemployment insurance benefits to the pre-employment earnings. It's really important to have social insurance programs for consumption smoothing. However, this depends on a couple of things. So predictability of the event, the cost of the event needs to be known. The availability of other forms of consumption smoothing must be known. So when should government be interfering? Government should be interfering in the social insurance programs and stepping up with strong social insurance programs. One, if the event is not predictable, for instance, me getting into an accident and having some disabilities is not predictable. Event needs to be not predictable. Cost of the event should be high. And other forms of consumption smoothing should not be available. In this case, government's role in social insurance becomes really, really important. I will see you in part 7 where we learn about moral hazard problem with insurance. Bye.